Hey traders, the topic today is the death cross, which occurs when the 50-day moving average crosses under the 200-day moving average. But how significant is this pattern? Historically speaking, has it lived up to the hype? As you may well know, death cross is expected in the coming few days in and around the 275 276 area on the daily chart of the SPY. So let's go back in time and examine previous occurrences to find out how many of them were timely foreboding signals, if you will, and how many were false alerts or lagging signals reflecting what has already happened. Okay, let's go back in time to the most recent occurrence of a death cross. As you can see, the cross happened several months after the market had been selling off. So the bulk of the sell-off had already occurred by the time the cross took place. And this is represented by the gray area. Had you taken that signal, you would have shorted the market right near the bottom, and that's represented by the red shaded area where a double bottom occurred. Now go back to August 2015 and you'll see that yet another after the fact cross occurred. The market had been in distribution mode throughout 2015, and finally the string snapped in early August, if I recall, well ahead of the death cross. Going further back in time leads us to August 2011, precisely late August 2011, when the death cross occurred, well after the market had finished consolidating throughout 2011 before eventually falling under its own weight in early August, well ahead of the eventual death cross in late August. Had you shorted based on that signal, you would have shorted the market near the bottom. Keep going back, and this takes us back to July 2010 when a death cross occurred. After all was said and done, the market had been in a downfall since April or May of 2010, and by the time the cross took place, the bottom was already in. Okay, going further back on our quest to find all these death crosses, we run into December 2007 when a death cross occurred on the heels of a multi-month distribution that set the stage for the 2008 bear market. Here, had you taken the sell signal upon the occurrence of the death cross, you would have been handsomely rewarded. Keep rewinding that clock and you'll run into a death cross in July 2006, but obviously that was a false alert that occurred near that double bottom. Had you gone short based on this death cross occurrence, it would have been a matter of days before you got eventually squeezed out of that position. Further back, and we land on that August 2004 death cross, which also occurred after the fact on the heels of a sideways consolidation that eventually led to further upside. So once again, a false alert in the form of a belated death cross that came on the heels of a multi-month consolidation with a downward bias. Last but not least, a death cross that occurred back in October 2000 on the heels of a multi-month consolidation following the March 2000 high. So, aside from the 2007 death cross, which produced a potent sell signal, the only other one worth taking into consideration was, of course, the October 2000 death cross. To sum it all up, we've had 8 death crosses in the last 18 years, only 2 of which were reliable signals. That's only a quarter. Now, with the impending one this coming December, which I believe will live up to expectations, we'll end up having 3 reliable occurrences out of a total of 9. That's a reliability factor of 33%, statistically speaking. So just like any other pattern in the market, the death cross should be considered in a broader context. It cannot be acted upon in a vacuum and without more corroborating data. Okay, that's it for now. I hope this was helpful as far as keeping you on the right side of the market. Feel free to follow me on Twitter or StockTwits, and also drop me an email should you have any follow-up questions. Have a great and profitable rest of the year.